Hello and welcome to CFA Society New York's podcast, Compound Insights. I'm your host, Rob Rowan. If it hasn't arrived, currency volatility is coming to a portfolio near you, and currency issues can creep out of the corners of even the most diversified portfolios. Today we're talking about those issues and others with Galen Hawes, CFA. Galen works at Veris Investments and OCIO. He manages discretionary portfolios, does research and analysis, and is on the investment team. Before joining Veris, he was the director of investments for the Screen Actors Guild and worked at Lord Abbett. In addition to his CFA, Galen has earned the Kaya designation. Now, any good conversation about currencies need to start with a reference. So our conversation will be from the perspective of a U.S. citizen investing in USD. So Galen, welcome.
Thank you. Yeah, thank you for having me. I used to be a member of CFA New York back in the day, before when it was the New York Society of Securities Analysts. Wish I could be with you in person, as we talked about. It's the first year since 2007 that I've not lived or visited New York, and so I'm disappointed I couldn't make it this year. But I'll look forward to making it back next year. And, just on your framing the conversation around the topic of U.S. investors, I would agree that I am a U.S. investor. All the clients that I work with and our OCIO business at Veris are U.S. investors, and many of our advisory clients are U.S. investors, or maybe I should say most. Our pension funds liabilities are in dollars, health plans, benefits in dollars. Operational portfolios, all expenses in dollars, foundation grants are in dollars, everything is from that perspective. So I think it's very timely. And as a U.S. investor too, I wanted to just kind of mention, why we think it's really important to talk about currency, and why I was excited to have this chat with you. It's complicated, involves scary things like derivatives. There are lots of costs, but we've really experienced one of the best times in modern history as investors from a capital appreciation standpoint. And we're starting to have a lot more conversations with our clients about meeting expectations going forward. I used to have a conversation with a pension that I worked with, and we were talking about private equity, not currency at the time, but in the 1980s, when that pension had started, the conversation, you could invest in treasuries or equities or whatever you did. You were never penalized for diversification, right? And so, you could invest all in treasuries and you would have still hit your objectives if they were 7-8% plus. Whereas today, interest rates are near zero. Equities, forward-looking, don't look fantastic. And so really, that equation of risk-free plus beta plus alpha, you've really got to think about each of those components when cash rates are zero, whether it's adding leverage, managing your betas and alphas. As a U.S. investor, I think this currency conversation is going to be really insightful on better managing your betas in that discussion.
Yeah, I mean, one of the reasons I was particularly interested to have this conversation right now is because of the direction of interest rates and how tightening will probably change some of the rates, even amongst the developed world currencies. But I think it is important for CFA members and this podcast to start with the risk first. So, and one thing I know is that as a person who's watched this from the outside is that tail risk from currency exposure can be massive. And the cost of hedging, as you pointed out, is pretty decent. So which types of clients are likely to derive the most value from the hedging of the asset owners you just mentioned?
Yeah, I mean, I agree. Tail risk can be massive, but it's massive for doing nothing at all, too. I remember a very large global infrastructure fund I had invested with, and I won't use names here of products or place which I invested, but I was looking at some of the returns I remember, and some of the key projects in this infrastructure fund were doing fantastic. But when I scrolled down and look at the net return over the recent period, it looked pretty bad. And I realized there was a few large infrastructure projects in the UK. And this was around the time when Brexit was really picking up steam and the pound was getting hit pretty bad. And it wiped out all of the returns for that investment for the period. So, as a U.S. investor and looking at that data, I didn't invest in the fund to say I want to take exposure to the pound, right? So, I was really hitting a kind of a tail risk scenario in my exposure within that sleeve of the portfolio. And it hurt quite bad. And so if we want to talk about costs of it and focus on the lowest cost currencies to hedge, perhaps is the way to approach it. Maybe the G10, the yen, euro, dollar, pound is perhaps most exposure that you have anyways in the developed currencies. And that's where we tend to find most clients exposed. And so, when you talk about which types of clients could derive the most value from it, again, if you're coming from the perspective of hedging, or I think one of the things that I'll probably lean on more in my conversation is beta management or currency management. I think all clients could perhaps benefit if again your exposures are in U.S. dollars. That non-U.S. exposure that you naively assume in your portfolio is a pretty big risk that can be quite significant, and so that's kind of what we try to target.
Yeah, and it's interesting that you mentioned that trade that happened around the time of Brexit. As you probably know, sterling is now around that level again.
Yeah.
So it recovered a little bit and came back. So some people are probably experiencing this now, as there have been some pretty attractive, from an asset allocation perspective, pretty attractive infrastructure deals in the UK in recent years. So I'd like to circle this around a little bit also to the return and the issue that you brought up at the beginning. Is it reasonable, in your opinion, to look at FX as a carry trade? Particularly with such low yields on all kinds of, or negative yields on fixed income?
Yeah, I mean, I think there's a couple of aspects to that. And I guess first I'll start off that carry is certainly one of those factors that we feel has proved out to be a benefit over the long term. But there are some risks there. And for example, during the global financial crisis, pretty big risk-off environment caused many trades to unwind. As flows moved into lower yielding safe haven currencies, the carry factor suffered a drawdown between, call it, July of 2007 and January 2009 of around 30%. There were other factors that did quite a bit better. And if you had a diversified portfolio of exposures to the different factors, for example, momentum and value, your pain was not nearly as great as a 30% drawdown on that exposure. Concurrently, there's a large number of, let's say, core bond portfolios that have actually done that trade. Say it's between the yen and the dollar, where they borrow in one, buy the other, and invest in treasuries or bonds in that other market and make some money. But that's a bet. It's an active move. It could kind of come back on you, as my example, the global financial crisis. And so it can be an opportunity, and it's certainly a factor that I think is worth pursuing. But I think it needs to be taken with some diversification and recognition that there are some risks that you could face doing that.
Have you implemented a strategy like that for any of the asset owners that are currently in your client list?
We've done a lot of work around the subject, and I'll be honest, there's, even as an OCIO, there's a lot of pushback from some clients just in the complexity of it. There's questions. So one of the ways that we've looked at approaching it is to recognize some of the risks that are around hedging your currency or managing the betas. And one of the biggest ones is, of course, pure risk. But also the risk relative to your policy benchmark. And so kind of a thought that we've had is if you could hedge 2/3 of your currency exposure to developed markets, replace 1/3 of that with currency factors that we think could benefit returns over time, and leave 1/3 unhedged to, again, recognize that pure component, that might be a balanced way of kind of stepping into managing your currency risk. But the problem with that is if you're looking at, call it, developed market exposures, and you're using the world ex-US benchmark as a framework for that, there becomes a question of whether or not you want to use that benchmark in your policy. So you're not fully wearing the beta delta there, or if you want to simply accept the fact that you're going to have very different outcomes over different periods. We still think most outcomes that properly managing your currency exposures is a benefit to your portfolio as a U.S. investor in particular. However, we do recognize there are periods of many months or potentially years where you could underperform by a material margin if that's not included in the benchmark.
Right, and that has been particularly difficult for a lot of asset owners recently, wearing the beta delta, of course, because of the relatively height of their performance. The endowments are all in the 30 percentile range.
Yeah.
So you missed that by a little, and your board might have something to say about it.
Exactly. You need some patience.
Now, if there is going to be a widening of the yield differential between currencies in the future, as some raise rates at different times, rates, et cetera, different policies come out more, we might see a bigger diversity of those. Are there other portfolio strategies that you would advise to clients who are trying to manage that?
Yeah, I mean, it's interesting when you talk about yield differentials, because kind of before yields started plummeting in the U.S. in the recent periods, I mean, you really had pretty wide yield differentials in the developed markets. I mean, there was almost kind of a kink in the pricing curve, if you will, when you looked at broad global yields and then you looked at the U.S. It made a lot of sense for a U.S. investor to sell another currency and buy the dollar, and there was a bit of a benefit there. But I suppose in terms of call it the other G10 currencies, and having a collapse of that yield differential across all those currencies, it had made it more difficult to, if you're saying buying the top three that are looking the best in that factor framework that I was talking about versus selling the bottom three, it does make things more difficult when there's not a lot of dispersion there to do that. So I suppose widening differentials could improve the potential outcomes that you could find. We're still in a world where you're getting paid more in the U.S. than you are in many of these other markets, and that can make things a little bit easier. Not as easy as it was, but a little bit easier than perhaps it were if they were all completely on par.
And when you were looking back to the time before 2005, I presume. When the differential
far beyond 2005, even. I mean, in terms of the benefit of key factors, the carry value and momentum, we're looking back into the 90s to see when those things benefited. But when I'm talking about some of the yield differential, I mean, that's certainly been the case after the global financial crisis, right. Where you saw, Germany, for example, or many countries around Europe, the yield on a lot of their sovereign debt was 0 to negative. Whereas, it was only until recently when the U.S. 10-year, for example, fell below 2%, and that kind of shortened up a little bit. But it's starting to get back there a little bit. As yields have come up a tiny bit. It's reverted a little here in the most recent week. But I think the most important thing for me to kind of express, if anyone's wondering where my perspective is on this, is and just what we do at Verus is I'm not trying to generate a ton of alpha in this space. We look at it again as beta or currency management and just trying to manage those risks. So we do take tactical positions and structure portfolios in ways that we hope will generate outperformance, but we're allocators of capital first and foremost, and we want to take advantage of currency moves. If that's the case, we want to hire somebody else who can do it. So all we're really trying to do we're not looking for alphas. It almost doesn't really matter. I mean, we get asked when we talk to either internally or externally about how we're going to implement managing the currency risk. Well, what are you going to do if the rates go up in the United States, or if they go down in Europe, or how does this change? And we're kind of like, it doesn't matter. I mean, I'm not investing in this because I'm telling you that the U.S. currency is going to rally significantly or anything. I'm simply just saying you have a risk in your portfolio that is only taken on by way of what you invest in. It's not intentional. And it adds a lot of volatility. And our work that we've done says you aren't paid for it over long periods of time. And so that's the only real approach that I'm coming at this. And so, I would hope an approach to manage your currency exposures is going to be a sustainable long-term benefit to you that you're not benefiting from today.
You know, there's a sort of interesting balance that every investor has to strike, and that's something you just said there. Even if you're just managing the risk and not going for alpha, there is always the possibility that you overmanage the currency, and that is particularly risky because the fees attached with these things. So, how do you all see that? Is there a telltale sign of that in the data that you look at in portfolios, or how did you come to that 30% that you reckoned earlier?
Yeah, I mean, it kind of. I mean, look, there's some the we call it a third approach, or the hedging the 2/3 versus leaving a third unhedged. There's some qualitative aspects to that, but it's really centered around the fact that there's peer risk, and we recognize that we're all, each one of our clients, they want to know, the pension funds are comparing themselves against other pension funds, the Taft-Hartley plans are comparing themselves against other Taft-Hartley plans. And whenever they'll come into a room to talk about their portfolio and hear from us how it's doing, they are comparing against their peers. And if there's a difference there, they're going, why is that difference? And we tend to get flogged the most when that difference is negative for them versus the others. And so and we also recognize there's a lot of volatility in the currency space. And so we simply kind of put that approach together to recognize that, hey, we get it. There's some peer risk associated with this. You're comparing themselves to a lot of people who naively assume this risk. And so it's a step to take to wade into this world of being able to manage these risks. You could ask, if currency adds a lot of volatility and no return, why not get rid of all your currency risk? But you do face the costs. You face the peer risks, like I mentioned. That may work out for you, and it very well may not for a long period of time. And so you really need to assess what it is that what's your risk tolerance in that approach. We look at the reason why we've looked at the factors, right? So looking at and this is a lot of work that not only we've done, but many others in the industry have done. And there's indexes that are constructed around this. There's firms that manage relative to these indexes. But there are factors within currency that do pay. And if you can possibly use those factors appropriately, you can hedge out risk, use those factors that do pay for some of the risk that can hopefully help compensate for the costs of the currency hedging. And together with those two things, you can manage your currency risk in a way that's not a drag on your portfolio over time. So, if you completely hedge everything out and you come from the perspective of, okay, I'm no longer going to have all that volatility, but I'm going to have no return on top of it, well, then it's going to be, with the cost, it's just going to be a drag. And so it's just like a passive, look at it just like a passive fund, right? So if I don't have passive fees of zero and I have a tracking error of zero relative to a benchmark, I'm certain to underperform by whatever those fees are over time. Currency could be the same way, but we simply feel there's a way to manage your risk where you can offset the costs with the proper factors that we think you're paid for the risk, while also hedging out some of that naive beta that you don't want. And that's just a better way to construct your currency program.
Great. Yeah, excellent. Thank you. Perhaps that's a good place to end, is the "it can be done" conversation. It's I guess one of the things that when I was prepping for this, I thought about this a little bit. That discussion you were talking about when the most of the rest of the developed markets went to zero or darn close to it, and the U.S. Stated 1.5 to 2%. I remember the first time that happened because I heard the U.S.'s bonds referred to as the world's cleanest pair of dirty jeans.
Yeah.
That has been reused. Now, that was before my 12-year-old son was born. It was the first time I heard that. So it gives you some idea of how long this has been going on for. So thank you, Galen. This is really helpful, and I appreciate your giving your time to us.
Yeah, no, I'm glad to have the conversation, and hope we can chat about it more. And I'm curious to kind of see how we start seeing more people implement this in the years ahead, because I'm sure it's going to be a bigger topic of conversation as we look for any way, any levers that we can pull to better affect outcomes in portfolios.
Oh, I'm hoping so. We're here in January. We will definitely have you back.
Sounds great.
And to those on the podcast, please do listen to our next podcast episode. It is an interview with Nanda Kamat, who has been thinking about managing a diverse team for decades at MUFG. It will drop on January 24th, 2022. If you're listening to this episode on our website, please consider subscribing on Apple Podcasts, Google Play, or wherever you like to find your podcasts. Thank you for listening. Until next time.